Okay, so we're going live with urgently. I'm going to give it a couple of seconds for the audience to populate before we kick it off. And welcome to the Sidoti Virtual Microcap Conference, and thank you for joining us today. I'm Anja Soderstrom, Senior Equity Analyst here at Sidoti, and as I mentioned, next up we have Urgently Inc. We have the management team with us. We have Matt Booth, the CEO. We have Tim Huffmeyer, the CFO, and we also have Jenny Mitchell. She's the VP of Finance and Strategy and Investor Relations. So this will be conducted as a fireside chat. Feel free to submit your questions and we'll incorporate them as we go. And with that, I'll hand it over to Jenny for some disclosures before we get it started.
Thank you. Good morning, and thank you for taking the time to learn a little bit more about Urgently. Before we get started, I'd like to remind you that our remarks today may include forward-looking statements. Actual results may differ from those projected in any forward-looking statements we make. I'd like to refer you to our safe harbor statement included in our investor presentation and to the risk factors section of our most recent 10-K filed with the SEC, both of which are available on our investor relations website. So with that, I'd like to turn the call over to Matt Booth, Urgently's CEO.
Thanks, Jenny, and thanks, Anja. I think what I'll do, Anja, if it's okay, if I'll just go through, 2 or 3 slides, just as some background for some folks that might be new to the Urgently story, and then we can take questions from you and from the folks on the call. So thanks everyone for joining us today. Urgently was founded in 2013, so about a little over 10 years ago, and the concept was pretty simple. AAA had 61 million members paying between $50 and $100 a month. So the founding team said, you know what, we should build a technology forward business focused around going after and building a better subscription mousetrap than AAA. And the team was making good progress on it, had a lot of digitization, and we'll show you some slides in a second about kind of what that looks like. And as the business started to scale up, a large German OEM was looking at the business and said, you know what? We're unhappy with the service that we have today. We really want a technology digital footprint or digital forward technology business that to improve the customer experience. And then it was off, got the first partner, and then, pretty quickly after signed up 50 more, and it was kind of off to the races. As we'll talk about a little bit later, and Tim can mention on the finance section, the business strangely has never really had a problem with growth. A lot of demand for what it is that we do. So we have, over time, gotten some fantastic investors in the business: Porsche, Jaguar Land Rover, and Motion Ventures, BMW, American Tire Distributors, and of course, Enterprise Rent-A-Car. We have about 150-ish employees. Most of our contracts are 3-year contracts. They're multi-year contracts directly with the OEM or the fleet company. Did about just under $150 million in revenue, and we do that through a network in North America of independent drivers, about 75,000 or 12,000 or so companies, and we cover all of North America 24/7. The piece that's really important to us and critical is exceptional quality. So on a 5-star scale, we score about 30% of the jobs, get feedback on about 30%. We landed about a 4.6 out of 5 stars, which is pretty great because no one aspires in the day, in the morning to have their car break down and not start. So we're pretty pleased with where that's going, and we're always trying to use technology to make it better. You can go to the next slide, Jenny. So just a pretty simple look at what you see as a customer. Very similar to Uber or DoorDash or some of the other kind of digitally connected experiences that are out there. Now, there's different versions of this that all the stakeholders see. So the tow truck driver will see one version, the customer will see another version, the parent, the OEM or the fleet company will see another one that we can show you in a second. And all stakeholders are connected digitally in real time. It's great for expectation setting. And underneath this, there are a lot of analytics and machine learning that we run kind of in real time to produce what we call our triggers that look at the job and say, hey, this job is going great, leave it alone, or this job needs some kind of intervention because there's a snowstorm or a traffic jam. We can talk more about that in a minute. And it's really this like transparency that's allowed us to grow as quickly as we have. Before we started this out, it was pretty much a black box, which is no one really knew what was going on. You couldn't see the driver. You didn't know when they were coming. And as Uber and others started to build these technology experiences, other industries like roadside assistance looked at this and said, well, we want that too. And that's really our primary technological moat. And we'll go through some items on the network in a second. Let's go to the next slide, Jenny. So here's a snapshot of what you see in Urgently on a typical Monday morning. All of the blue dots are disablements. And if you look down the right with the legend, battery, flat tire, fuel delivery, lockout, motorcycle tow, winch, typical roadside assistance that you get with AAA or others. And each of these different icons represents a different kind of disablement reason. So some of our partners actually have a version of this in their headquarters on a large screen TV, and you can press on any of these little dots and you'll expand the area and you can see exactly what's wrong, who the customer is, the driver that's coming to help the customer. So it's really this kind of real-time visibility that's been driving the business on a go-forward basis, and one of the reasons that we've been as successful as we are. Let's go to the next slide, Jenny. So a big piece that underpins this that you don't see, but that is really important, is this really is a pretty big geospatial and contextual database that underlies all of these things. And it's similar to like if you go to Google and you do a search for a local restaurant, except we're tracking the restaurant and the restaurant's moving and we're tracking inventory from both ends at the same time to match the restaurant and the customer with the right kind of service. In this case, the car is moving, the tow truck's moving, the parts are all different. So we have to manage all this in real time and take into account algorithmically, what's the traffic like? What's the weather like? Are there safety issues? Is it a restricted roadway? What's the vehicle? Who's the partner? What's the time of day? Is it rural? So all these things feed into the geospatial engine at the same time. And then we produce out of that the ideal service provider that needs to come and service the vehicle. And then we match that almost in real time with a network, as I mentioned before, of about 74,000 drivers or 12,000 companies. It's pretty sophisticated. And we've gotten better and better and add more data to it to refine it over time. And as you see, if you look at your financials, really we've taken the margin from 2% up to 25%. So pretty good over time. A lot of analytics around this that produce a better customer experience. And that's really what it's about. It's about making sure that the customer has an exceptional experience. Next slide, Jenny. Cool. I'll leave it here for a second, and then Anya, why don't we go to any questions that you may have?
Yeah, just wanted to first start with how if you can talk about how your technology is setting you apart from competitors, and who are your competitors?
Yeah, so there's two primary competitors in this business. One is a family business that was started outside of Boston in 1974. And they focus primarily on insurance companies. So they have about 1.2, 1.3, give or take, $1 billion of sole sourced insurance contracts. And on the other side is, AAA on the subscription side. And AAA was started in, 1902 when there were more horses than cars. And it's kind of grown over time, and it's an amalgamation of different clubs. I think 40 or something different clubs, kind of in the U.S., kind of a quasi franchise model that has a unified governance structure over the top of it. Now, interestingly enough, AAA sells insurance in most of the U.S. states. So if you're a big insurance company like Progressive or USAA or State Farm, you're not going to send your customers to them. That has allowed the company in Boston to grow pretty big because they were the only ones that had any scale until we came along, and they ended up with all the insurance contracts. So the market's split between two pieces. One is the subscription side with AAA, and the other side is on the insurance side of the business. So it's a good opportunity. And recently we have achieved enough scale where we can start to go after some of these large contracts. So our view on the market is that there is definitely an opportunity in the subscription business. Maybe, Jenny, you can go to the TAM slide just for a second, just to give folks a sense for what that looks like. Because it's a really big subscription business in the US. And then on the roadside assistance business, primarily it's these large insurance contracts. And we believe over time that they will be dual source. So if you remember a time, say before Amazon AWS, when most of the infrastructure and technology was in the cloud, when you actually had to have a physical data center, you always wanted failover data centers, one in Los Angeles and one on the East Coast, just in case something happened to one or the other. you could move volume around. And that's typically what we believe we're going to see. And what we see in some of our larger contracts is there's multiple vendors that support these large contracts. We believe that's going to continue over time. We believe that these large contracts will open up to more than one person. We believe that we'll be the beneficiary of that. So we're pretty excited about our prospects going forward now that we've achieved the scale that we've needed to achieve.
Okay, thank you. And we have a question here from the audience that kind of ties into the previous slide you had open. Can you discuss how you get paid and what the pricing dynamic has been historically?
That's a great question. So typically we deal with a couple of different kinds of customer partners. OEMs. So in the case, like as an example, BMW, or fleet companies in the case of, enterprise rental. Our contracts are directly with the fleet companies or with the OEMs. So we have a deal with the OEM corporate brand. And typically when you buy a new car, it comes with a warranty, and one piece of the warranty is roadside assistance. So if you get a flat tire or you get in an accident and you need a tow or you need a tire change, those jobs come to us. So we are paid by the OEM, and we pay the service provider, and we negotiate with the service providers, and we make money in between. Over time, our pricing algorithms and job algorithms have become more sophisticated. So it used to be most companies started out with rate cards. So they said, hey, in this part of the country, we're going to pay you $40. But really, over time, what we've noticed is it costs more at night or more during rush hour, and we can change the price up or down using real-time dynamic pricing to optimize experience and optimize margin.
Okay, and how much of your revenue is recurring and under long-term contracts versus transactional?
Well, most of how the business works is we get paid when there is a job. So if there's a breakdown, we get paid. So it's not really ARR, but it's about as close to ARR as you can possibly get, given that these are long-term contracts and we know how big the vehicle car park is, and we know how many breakdowns there are typically by brand of vehicle. So we pretty much know within a point or so about what the revenue will actually end up looking like over time. So it's pretty straightforward to forecast. The one exception is COVID. When people stopped driving, people didn't break down as much. So but you could see that kind of in some of our historical financials, that had a propensity to reduce revenue because there were just fewer jobs out there. But other than that, hopefully, knock on wood, we won't see another pandemic in my lifetime. The revenue is about as close to ARR as you could possibly get.
Okay, and hopefully we won't see another pandemic, but we have a lot of noise in the macroeconomic environment today with the tariffs and other things, uncertainties going on. How does that affect your business?
So a couple of different ways to look at it. One, when we first heard about tariffs, look, we were obviously concerned because vehicles come from all over the world, and the vehicles and parts are moved in and out of different geographies with real-time, just-in-time inventory. Interestingly, the dealers that we've talked to and the OEMs that we've talked to have had some of their best sales weeks and months since the tariffs were announced. So as soon as they were announced, everyone rushed out to go buy new cars. So the dealers and others are pretty excited about it. I think it's unclear what the long-term tariff policy is going to be and which countries specifically are going to be targeted by it and what the long run looks like. I would venture to guess that it will affect the aftermarket more. So as an example, if an insurance company, if you get in an accident and have to have your car fixed, those aftermarket parts that come from all over the place that are not OEM parts are probably going to be more expensive and harder to get over time. But I don't think anyone really has an idea yet on, are tariffs here to stay? Are they going to be here today, gone later today? Like, we don't really know, and we don't know what countries are going to be affected by it yet. So I think everyone's, in this business is long-term planning with plants and equipment. So everyone's kind of taking a wait and see approach to see how it all falls out.
Okay, thank you. And we have a question here from the audience. Are there certain types of vehicles which tend to be more profitable?
So it's not generally the vehicles that tend to be more profitable, but it's definitely the service type. So as you can imagine, rolling a tow truck is pretty expensive in terms of fuel and just heavy equipment. So while the revenue is higher on those particular jobs, the margin contribution is less. The jobs that are the most profitable are the ones that are soft serve on a purely percentage basis. So tire changes, battery changes, jump starts. Interestingly, one of the questions that we get quite often from folks are or is, what happens with EVs? Do they break down? Like, or is that good or bad for your business? And EVs tend to have a lot of tire problems and because of the torque in the tires. So we tend to see a lot of tire issues with EVs, which, from a business perspective, we like because those are more profitable jobs.
Okay. And what levers do you have to drive margin improvement?
So quite a few. I mean, a lot of the business is really built around two things, like one, network efficiency and network density. So this is probably one of our favorite slides. You can see back in Q1 22, we started at 6%, it's climbed up now to 26%. Really, this is just the hard blocking and tackling of what needs to happen over time to kind of scale the business. So lots of AI, lots of machine learning, lots of automation. And then we've done some price increases over time, and we've added a handful of new higher margin products, so like VIP programs and other things that are super high touch. So it's a combination of better product, better operational controls, better unit economics, looking at the right customers, the ideal customer profile, and then just doing the hard work to make sure that we're really paying attention to how the money's flowing in and out of the business. I think, we've been, as this chart shows, we've been pretty successful at, improving the margins since the beginning. We're super focused on that.
And have you set up a revenue and margin goal for
Yeah.
publicly?
So I think we've said publicly, like, our revenue and margin goal back before when the business was at 6%, our goal in the long run was 25 to 30%. We said that's going to be the sweet spot that we can get this business to, and everyone was like, "You guys are crazy. If you guys get this to 15, we'll be doing handstands." And now, we're right in that goal that we said we would be in, which is between 25 and 30%. I think we see a path to get it up a couple more points in this segment of the business. And then over time, as we expand to other new markets, like subscription, as an example, subscription has a much higher gross margin profile. So it'll be about adding those new products and then changing the mix of the business over time. So this business might be, 28, 29% over time, and then subscription may be at, 60% or higher over time. And it's just a matter of, changing the overall revenue mix over time to drive the economics higher.
Thank you. And you work with some rather large car OEMs. If you can just mention some of those and how penetrated you are with them and your sort of land and expand approach to.
So typically, we've started off with European brands that were very focused on, and English brands that were very focused on high quality, and then rental brands that are very focused on super high quality. We've started to expand into more kind of mass market OEMs kind of over time as people have realized, well, geez, we really need a technology kind of solution. Most of the contracts that we have today were probably 80% penetrated, give or take. And there's a lot of just new opportunity, both in terms of new programs that we can add and then to push the penetration up higher within the accounts. And then the way that this business works, interestingly enough, is the newer accounts that you sell are, 4 or 5 or 6 times as big as the accounts you typically operate on, because once you get enough scale, you can move up to the next tier of accounts. So like a mass market OEM sells, 4 or 5 times as many cars as a luxury brand. And then, an insurance company probably has 10x of a large OEM in terms of volume. So you can see as you move up in scale, the revenue also increases. So it's not like you add 10%, you're adding incrementally more over time.
Okay, thank you. And can you also talk about your go-to-market strategy and what that looks like?
Yeah. Typically go to market is we offer to do pilots where we'll say, we put us in for a certain percentage of the traffic, 10, 15, 20%. And most of the contracts have started off like that, where we do a pilot for a certain amount of time. It's usually fixed duration, maybe 6 months or something like that, or give or take. And we win by by having superior quality. So we're very analytically focused. We know exactly how the book should perform. We know exactly what we need to target. And we're pretty good at setting expectations with and goals and targets with the customer. So it's kind of a multi-phase sales process, Anja, which is like there's a pilot, and the pilot turns into, usually a percentage of the business, call it 15 to 20%. And then on almost all the accounts, we've ramped them up to at least, either 100% or 80% over time. It's kind of a land and expand opportunity, if you will.
Okay. And can you also talk about how large the addressable market is for you and how you see that evolve over the
Yeah.
next couple of years?
Yeah, there's a couple of different pieces. So one, there's the roadside assistance business, which is typically, if you think AAA. It's 25 billion globally, about 12.5 billion in the US. There's an interesting market that sits between, call it, insurance companies, OEMs, and fleets, which is this kind of connected vehicle data business. And we had bought a company a year ago, last October, called Autonomo, which was focused specifically on this connected vehicle data. And the way to think about this is your car is streaming data constantly to you. So in the future, there should be a point in time where your car, if it's going to break down, it's going to tell you. So you might get notified on your phone or your iWatch. It says, "Hey, Anya, your car is going to have a flat tire when you come out of the office today. Do you want us to send a technician out to fix it ahead of time?" So it's this kind of what we call proactive business that's coming, that we do in some cases now, but it's going to expand pretty quickly. That's a really big business that straddles between a handful of markets. McKinsey and others have pegged it over 100 billion. And then look, we love the subscription business. It's big market, 60 million people that pay between 50 and $100 a year today. AAA really is the only big subscription player, which is very strange in a market like that. That's the one. So we look at that and we think about how can we do that but better? How can we make it a better experience? How can we make it more price effective? How can we make the experience superior? And I think in the sooner or later we'll announce that we'll kind of think about how we go in and attack that market with something that's new and innovative that hasn't been seen before.
Okay, sounds exciting. And what are the biggest changes to the market that you're positioned to capitalize on?
I think the biggest changes, interestingly, are as follows. If you started this business in the 70s or you started this business in the 1900s, there weren't fax machines or GPS or computers or anything. So most of the competitor networks are set up around geographics. So, let's take Dallas, for instance. You probably give, one area, Richardson, Texas, to one group of providers. You would give Plano to another group of providers. You give Frisco to another group of providers, and North Dallas to somebody else, and they would get all the volume in those areas. Well, that's great unless there's an accident on 75 in Plano and those particular group of providers get backed up. You really didn't have a way to move assets around. So think of Uber, right? With surge pricing, where if Santa Monica's busy and you need to get people to Hollywood, you can offer economic incentives so that there's more vehicles that go to Hollywood. We have built technology to match the demand along the entire continuum of the job spectrum with the network. So we don't have exclusive geographic areas. So we don't have the problem that if someone, this is like under a franchise model, is busy, then the customer waits. We move the jobs around to different people that are open and available. And it's actually a pretty big sea change because most of the other competitors have negotiated contracts with specific rates and volumes to people. And in the end, if someone's busy, like in Plano example, if then the customer has to wait. And we pride ourselves on making sure that the customer gets experience, quickly. And I think our customer service scores, speak for themselves with 4.6 out of 5.
Okay, got it. And can you share if certain population centers are more profitable than others?
There's certainly more jobs and more revenue in population centers. That's absolutely true. But in terms of profitability, like you can imagine if someone is in, let's say, Colorado and they're skiing and they have to get towed a long distance, like those tend to be, expensive jobs. So we service people, pretty much everywhere. So it's, it's really, there's just, as you mentioned, there's more driving in population centers than there are in smaller places. So there's typically more revenue in those areas.
Okay, and another question here from the audience. Any thoughts on technology spending needs going forward, and what areas are the key focus on?
So if you pull apart our financials, you'll see that we've done a pretty good job of pulling down OpEx costs in the business. So we've reduced costs quite a bit. We have a lot of technologists in the business today. I think we have enough for this side of the business, but if we decide to say expand into something new, we might want to increase technology investment over time. But for where we are today, we feel great about kind of where we are on the tech spending.
Okay, and another question here from is key competitive advantages compared to peers.
It's really the technology and the data analytics. Like we have spent a lot on data and machine learning and what people call AI, which is just pattern recognition, and then the algorithms that feed the network and feed the pricing and feed the optimization. So we're constantly spending more on that and looking at how to improve it. So pretty big competitive moat, we believe, for us, just given where we see our competitors.
Okay, and another question here. When can we hear more concrete announcements on capturing new markets that you just spoke about?
I think we'll have some more announcements that are coming in the next kind of quarter or two. We have a pretty robust roadmap of new products that are coming out that we're excited to announce. We're not going to announce them ahead of time because we like to surprise the competitors when they come out. But there are definitely, as Jenny can attest to, a whole bunch of interesting things in the pipeline that we're excited about kind of this year.
And you recently closed the financing. Can you talk us through that?
Yeah. Tim, you want to take that one?
Sure. Yes, we closed in February. We extended our large portion of our hybrid debt out to July, to maturity of July of 2026. And then we replaced our first secured lender with a working capital line of credit with MidCap Financial. It's a $20 million line with another $5 million upside, and that secured off of our accounts receivable. So the good thing about this is as our accounts receivable base grows, we'll have access to more capital with that line of credit. That line of credit matures a few months. It's actually a 3-year line of credit, but it does mature in front of the hybrid debt. So we're working on the board is constantly looking at our strategic options related to that debt. Related to the hybrid portion, and is focused on making sure we have a solution for that as we think about the business over the next couple of quarters.
Okay, thank you. And can you just touch on just the balance sheet and your cash generation as well?
Yeah, so the the balance sheet right now, we're because we have the line of credit, cash is a little bit less important than it used to be. But we do have a $5 million liquidity metric that we try to manage to, and that's really unrestricted cash along with available borrowings on the line of credit. So that's a watermark that we have to stay above right now for both of our credit agreements. From an accounts receivable standpoint, we got good quality AR there, usually over between $20 to $25 million worth of accounts receivable. So we have a really good asset base there. And then on the debt side, most of our accounts payable and accrued liabilities are all kind of standard run rate. But then we do have the debt activity that I spoke about a few minutes ago that's out there. From a cash flow perspective, we're still burning a little bit of cash. We are happy to have reported in this last quarter our non-GAAP operating break even. We're just about there, and we're looking forward to growing the business and flipping to positive and then ultimately cash generation in the next couple of or several quarters. So we're excited about that.
Okay, sounds good. And I have one last question here from the audience. We sort of touched on it, but maybe we can elaborate a bit. With your current OEM customers, what is the current penetration on the customer base have you reached?
It's pretty high. Most of our OEM contracts that we have, we're the sole source partner. Some of the fleet programs that we mentioned, it's more like 80%. So it's pretty good. There's always new programs to add too. So we're always adding new programs and new opportunities. But
Okay, thank you.
if the question is like where the growth is going to come from, it's going to come from signing up new clients.
Okay. And we're actually out of time. So I'm going to hand it over to you, Matt, for some closing remarks. But first, I want to thank you, everyone who participated and the management team for joining us today. And also I know you have a pretty full one-on-one schedule, but if anyone wants to catch up with the management team, you can reach out directly to us or to the management team directly. And I'm sure they will squeeze you in somehow. And with that, I'll hand it over to you, Matt.
Well,
Thank you.
thank you, Anya, again for hosting us. It's always great to talk to you, and we think we get pretty fantastic questions from this group. So, if anyone wants to talk to us later today or later in the week, if you're not available today, by all means, please reach out to us at investorrelations.geturgently.com, and we're happy to schedule something that's great. So, I think the one thing I will mention is, Tim and the team, myself, have been super focused on getting to this first milestone, which is non-GAAP break even. You can see, looking over time, how much we've improved margin and how much we've improved the expense profile of the business. So, we're very bullish on where we can take this business over time. I think we've done what we said we're going to do, and this year we look to knocking down more wins and reporting more wins out to the folks here. So thanks again.